Welcome to the Deep Dive. We are Talk Tickers.
And today we're diving into a single, really critical source, the Flywire, ticker FLYW, Q3 2025 earnings call, which dropped back on November 4th.
Our mission here is pretty simple. We want to strip away all the noise, distill the core financial wins, the strategic moves, and maybe most importantly, the signal that management sent about the future.
And this deep dive is crucial. I mean, Q3 is the critical peak season for their education vertical.
Which is their foundation, right?
It's their entire foundation. So the question wasn't just whether they could deliver volume. It was whether their whole strategy embedding payments deep inside university software could finally insulate the business from all the macro and, frankly, geopolitical headaches we've seen over the last year.
And the immediate answer from the numbers, it looks like a resounding yes. This was a strong quarter that really reinforced that compound growth story.
It really did.
So let's start with the headlines. How did they actually perform against what Wall Street was expecting?
They delivered a clear beat on both counts. On the profitability side, you're looking at a non-GAAP adjusted EPS of $0.37.
37 cents.
Yes.
And consensus was what, 35?
35, okay. Yeah. So comfortably clearing that. But the real engine room total payment volume, or TPV, that was the star,
okay,
it hit $13.9 billion. That's a very, very healthy 26% climb year over year.
And all that volume translates straight into revenue, I assume.
It does. They posted GAAP revenue of $200.1 million.
Which, against expectations of around $185.8 million, that's a big beat.
It's a substantial 7.7% beat, and you've got robust 27.6% year-over-year growth. It's strong across the board.
So how did management sound on the call? Were they confident?
Oh, absolutely. Their tone completely reflected this success. They highlighted clear outperformance against even their own, high-end internal guidance. They kept emphasizing strong profitability, great execution, and resilience across all four verticals: education, travel, healthcare, and B2B.
What's fascinating to me here is the forward-looking signal. It's one thing to beat last quarter's numbers.
Sure.
It's another thing entirely to proactively raise your full-year guidance for 2025, especially with all this policy uncertainty still swirling around.
That move suggests a level of internal confidence that, it just speaks volumes about their execution right now and the stickiness of their platform.
It absolutely does. It sort of moves the whole investment narrative from a defensive one.
Right, from rebuilding investor trust after a few tough quarters.
Exactly. To a much more offensive story that's all about sustained growth, driven by that software penetration.
That's the key.
Let's talk quality over quantity for a second. With payment processors, you always have to strip out the low margin noise, right? So what's the specific revenue number we should focus on to really gauge the health of the core platform?
The one you want to zero in on is revenue less ancillary services.
Okay.
This figure helps us see the true platform revenue, stripping out things like third-party payment rail fees. And that core revenue came in at $194.1 million.
$194 million. That's an impressive 28.2% year-over-year growth.
It is.
But we have to put that in context of their acquisition strategy. How much of that growth was truly organic versus, the boost they got from M&A?
That's important context. You're right. We estimate the Sertifi acquisition contributed probably around 8 percentage points of that growth.
So roughly $13 million in Q3 revenue.
About that, yeah. So even if you back out Sertifi, the organic growth rate is still really strong and definitely represents an acceleration in the base business.
And that operational efficiency, it's really showing up big time on the bottom line. Adjusted EBITDA reached $57.1 million.
Which is nearly a $15 million increase year over year. That translates into a stellar 29.4% margin.
So when we see EBITDA margins expanding like that while TPV is surging,
that is the definitive evidence of operating leverage kicking in. It's proof that their infrastructure costs just aren't rising as fast as the volume and revenue.
Okay, but if we look closely, I do see one potential point of friction.
I think I know where you're going.
The adjusted gross margin, it dipped a little bit to 65.7%. That's down about 170 basis points year over year.
Yeah.
So if they're so efficient and the revenue beat was so strong, why the dip in the gross margin? Is that a red flag? Are payment costs going up?
That's a great question, and it's probably their most important nuance in these results. Management was very clear. This dip is not a cost issue. It's a successful growth issue. It's driven by a positive mix shift.
Explain that for us. How is a margin dip a good thing?
Well, they're seeing faster growth in two areas that just naturally carry slightly lower gross margins. First, their growth verticals like travel and B2B. They use more credit cards, which have higher underlying costs.
Okay, that makes sense.
And second, and this is crucial, they saw a really robust expansion in domestic transaction growth within education.
So not the high-margin international payments.
Yeah, exactly. Domestic payments, they're still profitable, of course, but they just don't carry that high take rate and margin structure that a big cross-border payment does. The dip simply confirms their strategy to move all the money, both high margin and lower margin flows, is working. It's expanding their addressable market.
And the overall operating leverage more than made up for that mixed pressure.
It more than compensated for it, yes.
Okay, so if that's the takeaway, that they're managing this growth efficiently, where does that spending discipline actually show up in the financials?
You see clear evidence of it. They're extracting more efficiency from both their sales efforts and their R&D spend.
How so?
Sales and marketing expenses, as a percentage of revenue, improved by 120 basis points. They dropped to 16.6%.
So they're spending smarter, getting more bang for their buck.
Getting more value per dollar of marketing spend. And their internal investments in the platform, same story. Tech and development spend improved by 160 basis points, coming in at just 6.4% of revenue.
They're scaling the platform without scaling the costs.
And that leads us directly to the driver of all those efficiencies.
Let me guess, AI and automation.
AI and automation. The company's investments in tech are now driving a visible decoupling of their growth from their support costs. This is where those R&D dollars are really paying off.
Are they quantifying that? Is there a hard number?
There is. They're using AI automation to push the self-service rate for payments and support up to 41%.
41%. That's a huge 28% increase from last year.
It's massive. And because customers are self-servicing, this led to a measurable reduction in the customer contact rate in the mid-teens.
Which protects operating margins as volume surges. They don't need to hire support staff proportionally.
That is tangible evidence of leverage right there.
Okay, moving to the strategic front. The breadth of the client wins is impressive. They signed more than 200 new clients across the portfolio.
Yeah, this is clearly not just an education story anymore.
But education does remain their core strength.
Absolutely. And we should look at that vertical first, because that's where their competitive moat is getting deeper. Management highlighted a successful diversification strategy. More than half of their new education wins came from outside the traditional Big Four study destinations.
The US, UK, Canada, and Australia.
Exactly.
So that suggests they are capturing students who are actively hedging against policy uncertainty or visa restrictions in those traditional markets.
They're positioned to follow the student flows wherever they go globally.
And their competitive barrier here is the student financial software, the SFS platform.
And it's becoming practically mandatory for large institutions. The value proposition is just stunning. It's way beyond simple payment processing. This is about accounts receivable management.
So how deep is that integration, and what's the hook for the universities?
The integration is what solidifies the whole embedded payments strategy. They talked about deepening integration with key university systems, particularly Workday Student, and advancing their UK higher ed ERP connections, specifically targeting the Aggresso Unit 4 pipeline.
It forces a single channel for all significant payment flows.
All of them, domestic and international.
But the proof of the ROI it's staggering. They said institutions using the collections management module of SFS have recovered $360 million in past due tuition.
That's not just a good number. That is the kind of return on investment that makes a university CFO sign the contract, and it makes Flywire indispensable.
Right. You're not going to rip out the system that just helped you claw back hundreds of millions in uncollected revenue.
That is the definition of a sticky competitive barrier.
Let's focus on the UK for a second. They mentioned UK revenues grew above the corporate average. What's the goal there?
The focus is just increasing the adoption rate at existing clients by driving that deeper integration. Right now, only about a dozen UK clients have a 90% or greater Flywire adoption rate.
And the path to getting that higher penetration is through integrating SFS with finance systems like Unit 4.
It's a land and expand strategy, and it's built entirely on software.
Okay, turning to their growth sectors. Travel and hospitality, which is powered by that Sertifi acquisition, showed really strong momentum.
Yes. They're clearly capitalizing on the high-end travel market. Think destination management companies, luxury accommodations. The cross-sell synergy is already materializing in a big way. They announced a master services agreement with AMBR, which covers over 1,400 locations.
It's huge validation.
It proves Sertifi can scale within these large enterprise clients.
And in B2B, the invoice-to-cash platform, that's from the Invoice acquisition.
1 year ago, yep. And it's validating its price tag, growing at multiples of the corporate average.
What's the secret sauce there?
Automation and simplicity. The example they gave from KnowBe4 was powerful. That company expects to achieve over 95% auto-reconciliation using the platform.
That's got to be saving them tremendous internal labor costs.
For sure. And finally, healthcare. Revenue growth there approached the organic corporate average.
Boosted by that marquee win they can now finally talk about.
That's right, the Cleveland Clinic. Winning an institution of that caliber is a massive reference account. And the MyChart and point-of-sale implementations are already underway across their US and UK locations. It shows they can handle these complex, large-scale health system rollouts.
All right, let's pivot and put this into the broader investor context. Let's start with the guidance. The full year 2025 outlook was officially raised.
It was. They raised their FX-neutral revenue, less ancillary growth outlook to between 23% and 25% year over year.
And crucially, they also raised the profitability target.
They did. Increase the adjusted EBITDA margin expansion outlook to between 330 and 370 basis points year over year. It confirms they're maintaining that profitability focus even while accelerating growth.
And they successfully framed the full year with their Q4 guidance, expecting FX-neutral growth between 23 and 27%. Did management give any warnings about timing or seasonality going into Q4?
Just a slight nuance. They noted that some Q4 activity may have shifted into Q3.
Why is that?
The extended October Golden Week holiday in China. But look, this isn't a structural demand problem, it's just a calendar shift. They're very comfortable with the full year outcome.
Looking further out, they gave a preliminary outlook for 2026, and they were definitely applying prudence over hype.
Which investors always appreciate.
They're anticipating some mid-single-digit pressure on growth in 2026. What's driving that conservatism?
It's built around two primary ongoing external headwinds. First, continued policy uncertainty in the U.S., especially around student visas. And second, continued demand softness for Indian students studying in the U.S. and Canada.
They're just being realistic about the geopolitical environment.
Exactly. And crucially, they stated that this preliminary view already accounts for the impact of smaller graduating cohorts from enrollment declines in prior years.
So they're baking the conservatism in. It suggests the actual outcome could potentially surprise to the upside if policy stabilizes.
Which is why that diversification is so essential. If the U.S. and Canada stall, the growth in the U.K., Europe, and those other destinations helps cushion the blow.
And what about capital allocation? How are they balancing investing in that software moat versus managing the balance sheet?
A very balanced approach. They repurchased about 0.8 million shares, so about $10 million, effectively managing dilution.
And paid down debt.
A good chunk of it, $45 million in debt. But their main focus remains those targeted organic investments, go-to-market, R&D, the AI components, while steadily bringing stock-based compensation down. It's trending toward 12% of revenue for the year.
It shows a maturing company. They can fund their growth internally while optimizing the capital structure.
That's it.
Okay, that brings us to our final segment, where we pitch an outrageous but plausible trade idea based purely on the information from this deep dive. And of course, this is not financial advice.
Right. So the whole investment case for Flywire, it really comes down to a fundamental tension, doesn't it?
On one hand, you have fantastic internal execution and growing diversification.
But on the other, you have this serious, unpredictable political risk hovering over them, especially with visa policy.
So our trade thesis centers on what we're calling integration arbitrage. It's a bet on the superiority of embedded software.
We propose a long-short integration arbitrage trade. The action is this. First, you initiate a short position on legacy payment providers, the ones still serving US or UK higher ed,
But they lack a comprehensive, deeply integrated software platform like SFS. They just offer commodity payment rails.
Exactly. You're betting against the traditional banking-style providers.
And you use the proceeds from that short position to go long Flywire.
And the rationale hinges entirely on the hardening of Flywire's competitive moat through those deep ERP integrations, Workday, Unit4, Tribal. Their strategy is explicitly to capture all payment flows, the whole move all the money approach.
So as Flywire successfully embeds itself deeper into university workflows to solve that AR problem, the legacy vendors,
They'll be slowly starved of volume. The bet is that SFS stickiness accelerates Flywire's market share capture at the institutional level, displacing competitors entirely, regardless of whether student volumes are volatile.
So the legacy vendors just suffer increasing churn as the integrated solution becomes the mandatory default system for the university.
It's a pure bet that software drives value in payments, and that software-driven displacement will accelerate churn for the unintegrated competitors.
That was a tremendous deep dive. Flywire delivered, they navigated the peak season, and they signaled a clear shift in their long-term narrative.
It's no longer about rebuilding investor trust. It's about sustained compound growth, anchored by those sticky SFS integrations.
They've built a globally diversified business, mitigating some of that country-specific risk, and now they have quantifiable evidence that their software is driving efficiency and profitability.
Absolutely.
So what does this all mean for you? Here's a provocative thought to leave you with.
If international students continue to apply to destinations outside the traditional Big Four, as the company anticipates, how quickly can Flywire really scale its services in those new regions?
And given that tuition rates are often lower in those emerging destinations, will that mix shift eventually dilute the overall platform take rate and the margin profile in the long run? Something to mull over as you research your next move.